What's going on, everybody, and welcome to another episode of Military Cashflow. And today, we're going to talk about 5 money mistakes to avoid in your 20s. And you can avoid them, throughout your entire life for sure. But you see, it's very common for people in their early adulthood to make these mistakes. All right. So now, before we get into it, you already know what to do. Go ahead and hit the subscribe button, hit the notification bell so you get updated with all the new videos, and then hit the like button. And then share this content, guys. Get some more people in there so we can start learning about this military cash flow. But without further ado, let's get right into it. So, mistake number 1 is simply not thinking long term. Okay. And when I say long term, yes, we're talking about retirement. Yeah, we're talking about healthcare, right? Because so many people get the job and they see this nice, beautiful paycheck. And what do they want to do? They want to spend it. They want to spend it. They want to spend it. Or they save it, but they don't really do nothing with it. What happens when your young, able body can no longer go to work? You're disabled, you're physically weak, you're tired. What happens then? People tend to think in their 20s that they're almost invincible, right? Hey, I was guilty of it too, right? But you think that, oh, I can work forever. I never intend to, stop working. I'm motivated. I'm hungry. I'll work till I'm 70, till I'm 80. And I can tell myself the same thing. But unfortunately, we can't necessarily control everything around us to include our ability to work in the future. So, understanding that we need to consistently think long term, we may want to actually participate in the employer's 401k plan, right? The military has the thrift savings plan. And with a lot of employer style sponsored retirement accounts, they actually have employer matches. Okay. That means if I pay a certain percentage, they're going to match me a certain percentage. So they're giving you free money. You're effectively doubling your investment immediately. Why wouldn't you take advantage of that free money knowing that it can pay off in the end? Right? So thinking long term to include things like health insurance, right? People like to think, oh, I don't need health insurance until I'm 50, 60, 70, right? When I have something to protect to make sure that my family doesn't have to come out of pocket. Well, here's the thing, the younger you are and in the better health you are, the cheaper the insurance premiums are, right? And once you really look at different types of life insurance policies and health insurance policies, you'll start to see that there may be some benefit from doing a term life insurance versus a whole life, right? And one of the things we love to talk about is whole life cash value policies. It's a great investment vehicle down the line, right? Whereas term is much cheaper. But again, we're thinking long term. So that's number 1 mistake, is many people do not think long term enough. They only see the here and now. Okay. The next very, very common mistake that everybody should avoid is buying an expensive car. That's a given, right? Buying an expensive car. So, as you guys know, you get some good money and you want to keep up with the Joneses. You want to show everybody that you're doing well. And so you go out and get a car. Now, here's the thing about a car. Typically, when you go out and you buy a brand new car, as soon as you drive it off the lot, it depreciates significantly. If you turned around and try to sell it back, they're not even going to give you your full money back. That sucks. Okay. A car is a depreciating asset. When we look at assets and liabilities, a liability, right, is something that takes money out of your pocket. An asset is something that gives you a boost in the asset column. So many banks and many lenders will consider a vehicle an asset because, in theory, you could sell that vehicle and get a cash value to add or to liquidate for your net worth portfolio. Now, the issue is the car depreciates so fast in value. What is depreciation? That means you bought it for 50,000. Well, now next week it's only worth 45,000. It depreciates, it goes down in value. Well, 5 years from now, it's only worth 30,000. You've just lost $20,000 worth of value, but you still have a loan that has $40,000 left, or whatever the case is. You start to lose value on that asset so quickly that as you continue to pay, especially with interest, you end up paying much more than the car was ever worth to begin with because it depreciates so quickly. And understanding in your youth This isn't the time to be flashy, guys, right? In your 20s, get you an affordable car, something good, something reliable, right? It doesn't have to be a beater, but get something affordable. Get it on the lower end, right? You shouldn't be spending $25,000, $30,000 on a car in your 20s. Just relax. It'll come. It'll come. All right. And mistake number 3, student debt. Okay. This is a controversial statement for sure. I am not saying not to go to school. All right. If you want to go to school for a multitude of different reasons, that is your prerogative. But there is no reason for you to just rack up enormous amounts of student debt when in reality, you have to think further ahead in the future. What are you going to school for? And can you get a job in that career field? And will it be enough income from that job to pay off the student debt? Okay. So here's an example. A lot of people will go to private institutions to get some sort of liberal arts degree. All right. Nothing wrong with that. But think about it. You go to this private institution, you pay a hefty tuition. And when you get out, there really isn't a demand for any of those types of degrees. Okay. Now you went and you studied it and that's fine. But now you get out and now you have a job. Let's say it's paying you $50,000 a year. Well, you still have all of your living expenses to include rent, potentially a car note, groceries, things of that nature. However much money you have left every month is not much to pay off this $50,000, $60,000, or even more, $100,000 worth of student debt that sticks with you forever, right? And so what we do is, especially younger, we're thinking that we need to go get this college degree to be successful, when in reality, we don't. Most of the people I know are working in fields that they didn't even study in college, right? They got a degree in whatever, and they're now working in hospitality, right? I actually had one of my managers when I worked at an enterprise rent-a-car as a teenager. He was the actual manager and he had a history degree. Didn't make any sense, right? So just think about what you're studying and how it's going to affect your ability to get a job in the end. And really, what does that potential income from that job look like to pay off that hefty student loan amount? Don't be that person who's 50 years old, still paying it off, or, just hit 40 and now I'm like, whoo, I just got my loans paid off. Again, nothing against that, but that will set you back tremendously on your financial journey. All right. The next one, number 4. Some of y'all are going to hate me for this. And I'm sorry, just being honest. Having pets. That's right. I said it. Now, don't get it twisted. A pet, that's something that obviously is a very emotional bond. And most people view their pets like family. Okay. And that's fine, right? If you feel like you absolutely want a pet or need a pet or whatever, get a pet. Get a pet. But most people do not think of the money side of actually owning a pet. They think, hey, I'm just going to buy this pet. It's going to cost me $500, $1,500, whatever it is, right? To buy the pet. Some of them purebreds, ooh, they are expensive. Some of them purebreds are expensive, but you just think, okay, I'm just going to buy it and I'm good to go. Well, come on now. What about pet food, right? Every month, that's a new reoccurring bill. What about veterinary fees or even pet insurance, right? If you just wanted to pay a deductible every time you took them to the vet for all the shots and everything else, pet insurance, that's another monthly fee, right? Vet fees, got that. Now, what about if you don't own a home and you're renting? You probably got pet rent or a pet fee or a pet security deposit. And you can quickly see that it may not necessarily be much. You may only pay, let's say, $1,000 up front to purchase the pet, but then it's a reoccurring debt of $200, $300, right? Who knows? Every month. Now, $200 may not seem like a lot, but in your 20s, when you're first starting out, $200 can be significant, right? When you're first starting out. So understanding that, going out, you bought the car, you got the nice little apartment, and then you got a pet, all your money's gone. Now, there's nothing else for you to put money into. There's nothing else for you to save with. There's nothing else for you to, invest with. So it's a really big thing to avoid, right? I'm not going to call it a mistake, but you need to consider the implications of actually owning a pet. Okay. Now, the last one, number 5, is simply not taking enough financial risk. All right. Yeah, bear with me. It's not taking enough financial risk. And what I mean by that is inherently when we think of investing, especially at a younger age, we think of essentially putting our money at risk. And this is true because we honestly can't control every aspect of every investment. However, when we're not actually putting our money to work and it's just like sitting in the bank account being stale, not growing at all, then what happens is we are missing out on all of these opportunistic years where we have the ability to bounce back if something goes wrong. Think about it. You're in your 20s, you got 20 years, 30 years of good working life, as long as everything else goes right. You got about 20 or 30 years of good working years there. You can bounce back if you lose $5,000, $10,000, hell, even $50,000. You could bounce back from that over time by taking calculated, well thought out, and educated investment risks. You can greatly accelerate your wealth, right? And your financial position before you ever hit 30. All right. So that was a quick video, guys, of 5 money mistakes that you should definitely avoid in your 20s. Educate yourself on financial literacy. Make sure that you're not taking on any unnecessary debt just to kind of fit in with the Joneses. Take a little bit of sacrifice, right? Self-discipline, control your spending, put that money to work. And I guarantee you will be much more set up than not only the average American, right? You'll be much more set up in your 30s than you ever expected yourself to be. All right. So without further ado, hopefully you guys enjoyed that quick video, which is those 5 quick tips. Go ahead and put down in the comments below maybe some of your money tips, or if you're already through your early 20s, name one of the biggest mistakes that you made in your 20s, right? Put it down there. Let's engage a little bit. And until next time, this is Mike Glaspie signing off.